Good afternoon, everyone, and thank you very much for attending the conference. I think this is my third or fourth year presenting at this conference, and it's very nice to see some familiar faces. I'd like to start with something that the Honorable Deputy Prime Minister said, which is uncertainty is no longer just a variable, it is a constant. And I think that's a theme or an issue that we need to keep in mind whenever we're investing, or not just investing, but just thinking about the global macroeconomy. Uncertainty has become ever present with every issue that we look at, whether it's economic, political, or geopolitical. In my presentation, I will cover three key issues for global markets, but I would call them three key uncertainties. I wouldn't say I have the answers, but I think there are key uncertainties that will drive the movement in global financial markets over the next couple of years. Now, before I talk about these three key issues, I wanted to show you a few interesting charts. The first chart, I think, is quite an interesting chart. It's a 5,000-year history of global interest rates. This is not compiled by us. This is compiled by the Bank of England. They published it a few years ago, and we've been updating it since then. It shows both short-term and long-term interest rates since 3000 BC, 5,000-year history. And what I think is interesting about this chart, obviously it tells us that we'll be entering the next decade with the lowest interest rates in 5,000 years. But I think we need to think about why interest rates are at this level. It's not just about the weak economic cycle. It's not just because central banks are cutting interest rates. It's because of two very important structural factors: demographics, an aging population in a lot of the major economies around the world, and technology, both of which tend to be deflationary and would be associated with lower interest rates for longer. So we can talk about what will happen to interest rates over the next 6 months to 1 year, but the longer term trend is clear. The global economy is moving closer to what Japan has been experiencing for the past 20 years, which is low interest rates for a prolonged period of time. Now, moving from the very long term to the very short term, I quite often get the question, if you look at the US Treasury market and you look at the US equity market, they seem to be telling us two different things. US 10-year Treasury yields are very low at 1.5 to 1.6%, suggesting concerns about growth in the US. If you look at the US equity market, even after the recent correction, it's close to a record high. Are they telling us two different things? My view is they're telling us exactly the same thing. You just have to look at the right measure. So this chart shows the US 10-year Treasury yield, the yellow line, versus the S&P industrial sector relative to the S&P 500 index. The point here is the S&P 500 contains a lot of defensive stocks. It doesn't tell us at an index level too much about growth. But if you look at cyclical stocks like the industrials relative to the overall index, it correlates very well with the 10-year Treasury yield. And it gives us a simple message, which is recession concerns in the US are more widespread than you would imagine just looking at the level of the US equity market. And the final point I wanted to make before moving to the key issues is, obviously we know a lot of emerging market central banks have been cutting rates. But one thing we look at is the language of emerging market central banks. So we use language recognition techniques to examine both the statements and the speeches of all the major emerging market central banks around the world. And the dark blue line you see is an index that we come up with to see whether emerging markets central banks are sounding hawkish or dovish. A very simple message here. Emerging market central banks today are sounding the most dovish they have in over 10 years, since the financial crisis. So not only have central banks been cutting rates, as we've seen across the world, but the language has become a lot more concerned, a lot more cautious, and a lot more dovish. Now, I wanted to cover three issues in my presentation very quickly. I wanted to talk about dollar funding, about the renminbi, and about fiscal policy. As I said, these are very uncertain issues, but I think are very important issues for both foreign investors as well as investors sitting in Korea. Now, the first thing, I want to talk about dollar funding, and you might ask, why dollar funding? Why not talk about whether the Federal Reserve is going to cut rates at their next meeting or not? I think, obviously, that's quite important, what they do with the policy rate. But what's even more important to me is the fact that the Federal Reserve, the biggest central bank, the central bank of the biggest economy in the world, has been caught unaware with a funding crisis that erupted 2 weeks ago in the US. Now, a lot of people ask, why did repo rates in the US spike as high as 10%? Was it because of tax payments? Was it because of coupon settlements? Why did this happen? This shouldn't be happening in the US. And the reason it happened was the Federal Reserve, even though a lot of banks were telling them that we're approaching a level where bank reserves will start to become scarce, they frankly didn't really listen. They said, let's wait and see. Let's wait and see what level of bank reserves is appropriate. And when we reach that level, then we'll decide to do something. And that's what happened in September. There was a week when bank reserves was about $1.45 trillion. There was a tax payment of $100 billion, a coupon settlement of $50 billion, and very quickly you reached what we call the upward sloping part of the reserve demand curve. For the past 10 years, we've been used to the flat part of the demand curve because it was an excess reserves regime. Bank reserves were very, very high as $3 trillion. But now we're at $1.3 trillion, and the Fed was caught unaware, and there was a massive spike in dollar funding. Now, of course, things have settled down because the Fed has started doing repo and term repo operations. By the way, this is not just a theoretical concept. If you look at reserves outstanding versus the spread between the Fed funds rate and the interest on excess reserves, the red dot here is the latest number from last month. And you can see quite clearly we're at the point at which any further reduction in bank reserves will lead to a tightening of dollar liquidity. Now, in our opinion, the Fed needs to do something very simple, which they need to return to an abundant reserve regime, which means they need to get bank reserves back to a level of at least 1.6 trillion US dollars, which means the Fed probably needs to expand its balance sheet by about $200 to $250 billion. And they need to do that as soon as possible. In our opinion, they should announce it at the 31st of October FOMC meeting. But it's by no means certain, because if you listen to the Fed chair at the last meeting, he seemed to suggest that the tightness in liquidity was a temporary phenomenon, and that the repo operations or the liquidity injections would be enough to deal with this issue. In my opinion, it will not be enough. And I think especially as we approach year end, as we approach the end of 2019, and as big systemically important US banks have to maintain reserves for GSIP reporting requirements, we will be in a situation where banks will not be providing dollars to funding markets or providing less dollars to funding markets, which could see a repeat of the funding tightness that we saw in September. And the more often this happens, the more difficult it becomes for a lot of market participants, including Korean investors, by the way, because it could have a spillover to the cross-currency basis markets. So again, this is the most important thing I'm watching on the 31st of October. We do think they'll cut rates because we do think the US economy is slowing faster than they expect, and this is not just an insurance easing cycle, but we do think there's a desperate need for the Federal Reserve to deal with the funding tightness that we saw back in September. Now, the second issue I wanted to talk about, which I think some of the other speakers will speak about as well, the renminbi. Now, before I talk about the renminbi, I was in China a couple of weeks back meeting institutional investors, and there's a very clear message from the investor base in China, which is that monetary policy is not doing enough. The PBOC, the Central Bank of China, is behind the curve in terms of easing monetary policy, which is very surprising because almost every other central bank around the world is easing policy, either aggressively, if not aggressively, at the very least they're cutting rates. So why is the PBOC not doing enough? If you look at past easing cycles by China, and you look at it in terms of financial conditions, what this chart shows is the easing in financial conditions that we've seen in the last 4 easing cycles in China, as well as the most recent one in 2018. A very simple message. China's policy easing has been much less intensive than before. And most of the easing has come via the exchange rate. China has not cut its benchmark policy rate. They have not cut the rate on their MLF liquidity injections. They've introduced a new LPR rate for new loans, but that's barely fallen. There is a deep reluctance in China right now for a variety of reasons to reduce interest rates or ease monetary policy at a time where growth is slowing, and obviously, as we know, US-China trade tensions are still high. So what have they relied on? Quite obviously, they've relied on the exchange rate. They've allowed dollar CNY to move above 7. This chart, by the way, shows the CNY trade-weighted index, or the so-called CFETS index, which is the blue line. versus the spread between Brazil and US soybean prices. You might ask why the spread between Brazil and US soybean prices. The yellow line is actually a very good indicator of trade risk concerns in the market. Because whenever the market becomes concerned about US-China trade tensions, Brazil's soybean prices trade more expensive to US soybean prices, because the expectation is China will buy more soybeans from Brazil rather than the US. And as a result, you can see the renminbi has been strongly correlated with this trade war risk premium. But we can be even more specific than that. And people, including us, have been more specific. We've looked at the implied dollar CNY level to offset the impact of tariffs that have both been implemented and are scheduled to be implemented over the coming months. So currently, tariffs up until the 1st September 2019 have been implemented. That would imply a dollar CNY level of about 7.2 or 7.21 as the table shows by our calculations. Now, of course, dollar CNY is not at 7.2. The PBOC's fixings have been just below 7.1. But keep in mind, if they kept the fixings at 7.2, dollar CNY would probably trade a lot higher, both in the onshore market as well as the offshore market. So the PBOC is being prudent with the fixings. They're keeping it below 7.1, ahead of the 15th of October. Why is the 15th of October so important? It's because when the 25%, the existing 25% tariffs will go up to 30%. And guess what? When that happens, the implied dollar CNY level will be meaningfully higher. According to this table, it will be at 7.36. And as such, in my opinion, if that happens, it will be very hard for China to keep the dollar CNY fixing level below 7.1. They will have to let it go higher. Now the question is, what happens on the 15th of October? I have no idea. The talks in DC between Liu He, Lighthizer, Mnuchin, and their respective teams will happen this week on the 10th to 11th of October. In my opinion, it is quite clear that China doesn't feel the need to make any concession during these talks, partly because they realize that the current administration is distracted by the current impeachment proceedings that are going on in the US. But perhaps more importantly, they realize that for the first time, the US administration is concerned about the domestic impact of the tariffs. This is why they delayed the 15% tariffs back in August to the 15th of December. And they said, we're delaying it because we're concerned about the US consumer and the Christmas shopping season. From China's point of view, they're going into these discussions thinking, yes, we'd like to have a deal, a partial deal, maybe on trade, and we might agree to buy more goods, agricultural goods from the US. But why should we make any concession on industrial subsidies, on IP, on national security at this point? So ultimately, this week really depends on what the US wants to do, and in particular, what the White House wants to do. Do they want to go ahead with a partial mini trade deal? Or do they want to continue to integrate all the issues together, which has been their stance previously, that trade, national security, IP, all of this is interrelated? I don't know. I don't have an answer. I do think there's a possibility that we get a small interim mini deal, which would be defined as China buying more agricultural goods, the US allowing US companies to temporarily sell to Huawei, and the 15th October tariffs being delayed slightly, maybe to November or December. But for the global economy, that's not enough. I think for a small deal that just pushes the problem down the road is hardly going to lead to a recovery in capex or hiring by big global manufacturers, particularly those in Asia. So we could get a small risk on, a temporary risk on, but I think it would be temporary. Now the final issue I wanted to talk about very quickly is fiscal policy. Usually when I speak to investors and I ask them, interest rates are low, interest rate curves are very flat, what do you think will ultimately lead to steeper interest rate curves and higher global interest rates? And everyone says the same thing, fiscal policy. We need to see aggressive fiscal easing. Now, one thing to remember, the big decision for global policymakers is how to deal with inequality and populism. And there are three broad ways to deal with inequality and populism. There's protectionism, which is happening in a lot of countries, including most notably the US. There's redistribution, things like higher minimum wages, universal basic income, wealth taxes, which is being considered in some countries. And then there's Keynesianism, which is fiscal easing or aggressive pro-cyclical fiscal stimulus via tax cuts as well as higher spending. The problem is, when I ask myself the question, can fiscal policy come to the rescue? And I look at fiscal balances across the world. For the most part, countries are already running large fiscal deficits as a percentage of GDP, somewhere between 2 to 4% of GDP on average. So in aggregate, there's actually limited room for a lot of countries to ease fiscal policy aggressively. But then there are some countries where there is room to ease fiscal policy. And the two examples I like to think of are Germany and South Korea. And you can see on the chart, obviously, Korea has a fiscal surplus once you include the Social Security Fund, and similarly, Germany, which is on the extreme right-hand side, runs a fiscal surplus. The two economies are actually very similar. Big exporters, aging population, current account surplus, very low interest rates, plenty of room to ease fiscal policy. But their responses have been very different. Germany has been very reluctant to break its balanced budget rule. They've said we will only break it in the event of a crisis. And by the way, easing fiscal policy in the event of a crisis is not going to be the best thing because fiscal policy tends to have a very lagged impact on the economy. So it'll probably be too little, too late. But of course, I've been very impressed by the fact that Korea has been much more aggressive in terms of easing fiscal policy or planning to ease fiscal policy in 2020. So as we know, the expected budget spending increase in 2020 is going to be over 9% year over year and is going to be spread across various fiscal spending reforms. And in my opinion, this is the right thing to do for any country where interest rates are very low, where monetary policy is running out of space to ease, and where the government has room to ease fiscal policy, they should. And in Korea, it's happening. They're not doing it in Germany. I think they should be doing it. In the US, they did fiscal policy. They did massive tax cuts last year, but it was not very effective and growth is looking very weak. And therefore, they should be thinking of other fiscal measures, including a potential payroll tax cut. I don't think fiscal policy will save the day, but I do think we do need to see more fiscal easing across more countries around the world. I'll stop here and leave the rest of the discussion for the panel. Thank you very much.